You've seen the headlines. You felt the pull. On one side, you have the titans of Wall Street, the world of stocks, dividends, and 100-year-old companies. And on the other, you have the wild, electric frontier of cryptocurrency, a 24/7 global market, fueled by memes, tweets, and the dream of hitting a 100 times return overnight. So you're caught in the middle. Do you invest like Warren Buffett, focusing on decades of slow, steady growth? Or do you dive into the crypto chaos, hoping to catch the next rocket to the moon? It feels like you have to choose a side. The old world or the new one? Stability or explosive growth? But what if I told you that's the wrong question? What if the smartest investors aren't choosing a side at all? They're playing both. And they're doing it with a powerful strategy that turns this chaotic battle into a disciplined, wealth-building machine. Today, we're not just talking about stocks versus crypto. We're talking about how to combine them to build a truly resilient portfolio for the modern age. To understand how to combine them, you first have to understand their psychological DNA. They are driven by completely different forces. Investing in the stock market, at its core, is about owning a piece of a business. Its value, in the long run, is tied to real-world things like profits, cash flow, and its competitive advantage. Sure, emotions play a role. Fear and greed drive bull and bear markets. But the stock market has a gravitational pull back to reality, back to the fundamentals. Cryptocurrency is different. For most coins, there are no earnings reports, no factories, no assets you can touch. It operates in a world of pure market sentiment. This is the world of FOMO, the fear of missing out, that primal urge you feel when you see a coin double in price and you weren't on board. It's also the world of FUD, fear, uncertainty, and doubt, that wave of panic that spreads like wildfire after a single negative tweet, causing prices to crash in minutes. Stocks are a game of numbers and patience. Crypto is a game of psychology and nerve. One is a marathon, the other is a sprint. Surrounding it are your satellites. Smaller, faster, more agile objects that have the potential for explosive journeys, but don't threaten the stability of the entire system. Your core is your stock portfolio. Your satellites are your crypto investments. Let's talk about building your core. This is the foundation of your wealth, typically making up 70 to 80% of your portfolio. The goal of the core isn't to make you rich overnight. The goal is to keep you rich and build wealth steadily over time. This is where you invest in broad, diversified assets like S&P 500 index funds or ETFs. You're buying a slice of the entire American economy. Or you can focus on what are called defensive or high-quality stocks. These are the fortress companies that can weather any storm. Think of industries that people need no matter what. Consumer staples like food and household products, healthcare, because people always need medicine, and utilities, because we all need to keep the lights on. These companies have strong balance sheets, low debt, and consistent cash flow. They are the bedrock. This part of your portfolio is designed to be boring, predictable, and powerful over the long term. Now for the exciting part, your satellites. This is the smaller, more aggressive part of your portfolio, maybe 20 or 30%, where you place your crypto bets. But we're not just gambling here. We are making calculated bets using a concept called asymmetric risk. Asymmetric risk simply means you're making an investment where the potential upside is exponentially greater than the potential downside. Think about it. If you invest $100 into a stock, you hope it might double or triple over a few years. Your potential gain is maybe a few $100s. But if you invest $100 into a small, promising crypto project, your downside is capped. The most you can possibly lose is your $100. But the potential upside? It could be 10 times, 50 times, even 100 times. A single big winner can pay for all your losses and still deliver life-changing returns. That is a powerful asymmetric bet. You are risking a little for the chance to gain a lot. This is the correct way to view crypto investment. So what's your current split? Are you 100% stocks, 100% crypto? Let me know in the comments below what your core satellite ratio would be. 80-20? 70-30? There's no single right answer. So we have the strategy, a stable stock core and high-growth crypto satellites. But how do you actually execute this without letting your emotions take over? You use one of the simplest and most powerful tools in all of finance, dollar cost averaging, or DCA. DCA means investing a fixed amount of money at regular intervals, no matter what the price is. For example, you decide to invest $100 every single Friday. When the market is down, your $100 buys more shares, or more crypto. When the market is up, your $100 buys less. Over time, this strategy averages out your purchase price and, most importantly, it takes emotion completely out of the equation. You're no longer trying to time the market. You're no longer staring at charts wondering, is this the bottom? Is this the top? You just invest. every week, like clockwork. This discipline is the secret weapon against FOMO and feud. You can apply this to both parts of your portfolio. Set up an automatic investment of $100 a week into your S&P 500 index fund for your core, and set up another automatic investment of, say, $25 a week into Bitcoin or Ethereum for your satellite. You have now automated a sophisticated investment strategy. You are building your stable core and taking your high upside shots, all without the emotional stress. And this brings us back to the most important quality for any investor: temperament, not intellect. The core satellite strategy is a psychological masterpiece. Your stable, slow-moving core acts as an emotional anchor. When your crypto satellites are down 50%, you don't panic sell, because you know 80% of your wealth is safe and sound in your core investments. And when your crypto satellites are soaring, you don't get greedy and go all in, because you have a disciplined plan that you are sticking to. This is how you begin to think like the greatest investors. You stop reacting to the market's daily mood swings. As the legendary Peter Lynch said, "Far more money." DCA and the core satellite strategy are the embodiment of that wisdom. You stop anticipating and you start participating, consistently and intelligently. So let's put it all together. Stop thinking of it as stocks versus crypto. Start thinking of your portfolio as a core and its satellites. Recap. Your core is your foundation. Broad market index funds and high-quality defensive stocks. This is your stability, your anchor. Recap. Your satellites are your explorers. A small, calculated allocation to high-growth assets like cryptocurrencies, where you can take asymmetric risks. And your engine for both is dollar-cost averaging, the simple, automatic tool that builds discipline and removes emotion. This is how you harness the stability of the old world and the explosive potential of the new one. You move from being a gambler, tossed around by the waves of market sentiment, to being a strategic architect of your own financial future. If this strategy makes sense to you, hit that like button and subscribe for more content that cuts through the noise. And share this video with someone who is still stuck in the stocks versus crypto debate. It's time we started investing smarter, together. If you have not subscribed yet, subscribe this channel and share the video with your friends.